Today, more from the property market front line and from a Western Australian perspective. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. And today I'm joined again by Tony Locantro. Hello, Tony.
Good evening, Martin. How are you going?
Yeah, very good. And good to have you back on the channel. And it's been a few weeks and a lot's happened. Yeah. So it's a good time to catch up again just before the end of the old year. And I think perhaps we can have a little bit of a chat about what's happened, but also what may be happening next year. And I think I should compliment you on the new setup there. Your audio is really good. So congratulations on that.
Yeah, I saw in the comments that some of your viewers don't like the audio, and I think I look a bit pale. So I've rectified the problem.
Yeah, very good. Yeah, well, image is everything. Now,
that's it.
There's a few things I'd like to talk to you about, but let's go straight to one of the most interesting, which is that you've actually been on the receiving end of trying to get a loan, and it's not been easy.
Yeah, what I do when I'm bored, I'll go out and look at home opens. I've been looking around 10 kilometres within the CBD in Perth. So I'm with a new partner. We're not really... It's a bit early to move in with her. I hope she's not watching. Well, she will be watching this. But I walked into a home open and, geez, this place felt like home. So I put an offer in pretty much straight away. And finally, I've just got conditional finance approval after 5 weeks. So we submitted our applications, and this house was less than 2 times our income. Less than 2 times.
Right.
I'm a good saver because I can't spend what I earn. So I'm a minimalist, and the only reason why I showed 3 months of savings is I couldn't spend all the money I earn. And one thing, I'm not a property investor. I'm a share investor. So I'd build up a portfolio, and I've just been involved in a company that's done extremely well. I can't mention it due to a media ban. But suddenly, my portfolio in that stock's worth more than the house, and I've still struggled. And my partner's income, which is very good, she's got a good job, was hardly taken into consideration. And she had a few credit cards that her limits were pretty much full, but they counted that to the debt. So we submitted what I thought was a very good application. And one of the big four said, basically, no, we want 20% deposit. And I thought, well, there's no way I'm giving up my shares to do that. And what we've done is mortgage brokers are now going to pepper money. So it's not subprime, but I've had to pay an extra 1% than a big four bank to get the home. And I thought, well, that's worth it. But I've actually got a list of reasons why I didn't get the loan. And they started with a weak balance sheet, which I disagree with totally. It's my right to own shares. And as far as I'm concerned, Martin, shares are savings. I don't have to. Why would I leave cash in the bank earning sweet FA? And they said, stupidly, when I had a bit of a shopping binge, I went to Harvey Norman and on that 50 months interest free, and I ended up with a Go MasterCard. And I hate this card because I get fees and sometimes I forget to pay it. And I was a few days late, so they got a late payment fee. So that went down on the reasons why I didn't get the loan, even though I paid the stupid thing off 2 years early. And I stuffed up a payment on my car loan. It went to the wrong account, so that was noted. And it was just unbelievable. And I'm 47. And they actually said that the age was a consideration as well. And here I've demonstrated to the bank that I could possibly pay cash for this property. Unbelievable. So the procedure with Pepper has been quite onerous. We've had to put all our statements in, showing 3 months. Everything has to be well scrutinised. They have asked a couple of questions, but I feel like a criminal, having to pay an extra 1% on a home loan. And I get the vibe that a lot of people are going to start going to Pepper. Yeah. So, yeah.
Well, it's interesting because, of course, my surveys show me exactly the same thing. So firstly, people are having to jump through hoops just to provide a whole lot of additional information. And in some cases, my view is that the degree of information that the banks are now asking for is just getting stupid. But secondly, a lot of people are finding precisely the same, that effectively they are being rejected. About 40% of applications, or more than that now, are being rejected, 5% a year ago from the surveys. And quite a lot of them are ending up in the non-bank sector, so people like Pepper. So it's really interesting. Of course, Pepper's growing about, the non-bank sector is growing overall about 3 times faster than the ADI sector at the moment from a mortgage perspective. So it's not surprising. But what's interesting is your last point there was that you're having to pay more, right? So effectively,
1%,
what it means is that people are actually having to pay a higher mortgage interest rate, which means, of course, that that the non-banks are able to actually turn quite a good level of profitability and take a slightly higher risk profile. And of course, they don't have the same onerous capital requirements as the ADIs do, so they're actually a bit freer in terms of their funding and in terms of the way that they actually structure their business. So I think this is a really, really late cycle warning, because this is precisely what happened in the US in 2007 before the GFC. So at the end of the cycle, as it were, when rates started to move up, again over there, the lending standards started to get tighter, and there was a big flurry into the non-bank sector in the US. So I'm afraid, to my mind, this is another leading indicator of trouble ahead.
Well, I think Pepper are going to become extremely popular, because I know mortgage brokers are saying, well, Pepper will do this, Pepper will do that. And they say, well, these guys are realistic. Well, of course, if the bank's not going to value my share investments, then what's the point? And anyone that says they can save 20% deposit, I mean, bollocks, really. I mean, let's face it, a lot of this bubble's been funded by parents' balance sheets and personal loans and any way they can get money. And I guess they're making everyone feel like a criminal. But I know there was one savings event that recently happened, Martin. That was the hailstorm. I was just wondering how many people would have been tempted to push out their SUV into that hailstorm, because I know, but I mean, a lot of people would have been thinking about it. So,
Well, it's certainly, that again, the surveys highlight that the financial pressure that many are under. Let me sort of just widen the conversation a little bit then. Now, I've looked up the Perth market again in the last few months, and it's now down 15% on average from its highs about 4 or 5 years ago. In some of the locations outside Perth, it's a lot lower than that, some of the mining centres. But I suspect that the real story in Perth is way more complicated than that, and there are probably still some areas where there is a little bit more momentum and opportunity. But how are you seeing the local market in Perth?
Yeah, well, I have done a lot of home opens. I live in the Mount Hawthorn Leederville area, so I'm about 4 k's from the city. And to get a decent house near I live, I'm still going to pay $1.3 million. So I bought a unit in this area, so I can pretty much walk to work, and it's a very good area. As you go out towards Yokine, you're going to have to pay about $650 to $700. And I actually went 2 kilometres north, and I got a house 8 kilometres from the city. It's 8 kilometres to Trig Beach and 5 kilometres to a shopping centre they're going to spend $600 million on. Like a 2-storey, 3-bedroom, 9-year-old house in an estate with $700,000, $800,000 houses, and I got it for $560,000, which is the price of a unit. The previous seller paid $660 for it and spent probably $50 upwards on it. So he's taking a $200,000 capital loss in 5 years. Unbelievable.
And I'm seeing the same on the surveys again. A lot of people now in negative equity over in the West. And the other thing I've noticed that investors are seeing that the rentals that they're able to get on those rental properties now have dropped between 15 and 20% on average. So it looks to me as though both the investment sector and the owner-occupied sector are really up against it at the moment. Yeah,
it's been like being sandpapered to death. And I was around when the rental, we had a rush on rentals, and the rentals were astronomically high.
Yeah.
And my partner's house, she lives in Morley, over 12 years, she hasn't made a cent. And one of my favourite suburbs, value-wise, is Dianella. And the 10-year growth in that period has been under 1%. And now, in Dianella, they had the old Channel 7 studios, so they've turned it into a housing estate where the land you can buy it for about $1,000 a square metre, and people are putting like a Webb Brown Neves, which is probably upper AV Jennings or one of those builders. So young couples can build a decent house for about $650,000, $700, 8Ks from the city. So that's what we're seeing in Perth. And I think that's reasonable value. And that was always going to be my plan B till I found this absolute bargain. And I've noticed that on Twitter, the people saying one of the world's biggest housing bears has just bought a house. But I've got to have somewhere to live, Martin. So
well, and that's I
That's
think
it.
one of the points that I make, that actually a house is predominantly somewhere to live,
shelter,
rather than just seeing it as an asset class, which can only go up, right? I mean, it still amazes me that the surveys again tell me that a lot of people still say property always doubles every 7 years, full stop, right? They still believe it, even now.
Well, that's the biggest load of bullshit, because what I do, I've done quite a lot of research to these interviews, and the average price movement of a house in Australia between 1890 and 1990 was 0.5% per annum.
Yes.
So that's just complete nonsense. And let's face it, speculators are being spoiled. And what I keep saying to people, Martin, is that credit drives house prices, wages drive rents, and that's it.
Yeah, spot on. And we all know the credit boom that's been going on. We've been talking about the debt bomb over the last 2 or 3 years. And that's why house prices relative to international benchmarks, look at the BIS data, just underscores again that we are way out of kilter. The debt ratios are still very high. And, of course, credit is now tighter. Your own case is a good example of that, but I'm seeing it across the board. And frankly, even the 30% speed limit going on the interest only, that will have very little impact, in my view, in terms of the current environment, simply because of those tighter underwriting standards that are now running across the board.
Well, that's just a band-aid to a shotgun wound. Yeah. It's not the interest only, the new ones, it's the old ones that are going to fall due. That's just another reason that the likes of Kukulis and Switzer are trying to defend their position, but they've got no defence. I mean, it's like the Skeptics Association have offered someone $1 million to prove that the supernatural is real. I mean, no one's done it, and no one's going to do it because it's all a load of rubbish. But if I could see one of these mainstream economists justify our house prices, well, it's a similar thing, and they can't. They can't, Martin.
Yeah, well, of course, you took up the bet that I refused to take up with Kukulis a few months back, and I have to say, regretfully, your bet looks pretty good now.
Yeah, he's posting. He finally sent it public, and he's saying, well, a 35% correction is unlikely. But I take heed. I follow a guy called Morgan Kelly in Ireland. Mm-hmm. He's brilliant. And again, viewers should watch that debate with Jim Power, because it's like, it's amazing. It's like that one-finger salute battle we saw on Twitter. But he said that in a typical bubble, house prices lose 70% of what they've gained. And these gains in Sydney and Melbourne are actually off the charts relative to the rest of the world. So if you look at the trajectory, this is going to be the mother of all corrections, and it's unfolding now.
Yeah, well, I think that's right. And what's interesting is that I've studied bubbles around the world, particularly housing bubbles, and the attempts that have been made to try and create soft landings. And I can tell you there has never been a soft landing to a property correction. So I would be very surprised if magically the Reserve Bank and APRA were able to pull a rabbit out of a hat on that one.
There's no way the soft landing can happen. I mean, I liken it to a pilot trying to land an A380 with no gear. It can't happen. And we're not different in Australia. All we've had is cheap money. Yeah. That's it. And we've got speculators who think they can build multiple townhouses and sell them at a profit. And we've got young couples, first-home buyers, duped into buying a $750,000 house out near Penrith. I mean, that's like wow wipeout.
Yeah, absolutely. And we're seeing those prices fall. They're down, in some cases, 20, 22% already. Now, let me just take the conversation slightly wider then, Tony. We've watched the stock market locally and in the US over the last couple of weeks. And, the US market is down significantly again. What's your read of that? And do you think this is the start of, something very significant, or is it just a sort of a temporary wobble? How do you read it?
Well, I've had a bit of an excitable week. So I've been waking up and watching the Dow Jones. Yeah. And what I see is, I think financial markets and housing markets are a collaboration of people that have NFI what they're doing. No one knows what they're doing. No one can predict anything.
Yeah.
And the selling at Wall Street looks selling for the sake of selling. And I've said to my clients, I'd like to see the Dow Jones around 19,000. So I think we've still got over another 10% to fall. Mm-hmm. And the US market is overvalued. So our market is copying it. But your viewers should be mindful that our index is made up of the big banks and major resource companies. So you have to look beyond the index. But this is certainly a nasty bear market. And it just turns into a stock picker's market as it should be. But I just think that the US market, we're getting used to these falls now, that even a 700-800 point drop on the Dow kind of shakes us a little bit. But I actually think it's quite an orderly correction at this point.
Mm. Yeah, and I noticed that the Treasury guys in the US were saying there was an overreaction to the Fed's statement that they were going to continue to raise rates next year, and that in fact their expectation was that people would come out of bonds and actually start buying the stocks and shares simply because their pricing now is beginning to be, slowly, not yet, but slowly will become a little bit more rational. But my own view is I think there's a bit of a way to go before that happens.
Absolutely, and I think that their market was due for correction. We Australians are more like Canadians than the Americans, but we'll follow the US. And yeah, I just think that the markets have been overpriced on this flood of cheap money, and that cheap money is getting harder. And I was broking during the GFC, and it just felt as though the world financial system was freezing. And I think that's what's happening to the property market now, in that no one can get loans. And if you can get one, you've got to go to Pepper and pay more.
Yeah.
So
And interestingly, it's often the property market that leads the rest of the economy down, right? So if you look at, again, international trends, often it's the property market which goes first. In fact, in the GFC, the property market started turning a couple of years before the GFC finally hit. So, I think we've got that same sort of phenomenon going at the moment.
Well, the RBA's got a problem because they're not trying to manage an economy. They're trying to manage a housing bubble. And if you actually look outside of the housing figures, our economy isn't that bad, and there's no way known to man that 1.5% cash rate is justified. So they're going to have this huge problem, massive problem.
Yep. Okay, I agree with that, and I think they've created their own problem by taking rates too low, and then effectively allowing, with APRA lending that was too loose, and then they're trying to sort of claw it back, and then of course they're trying to talk the market up, and then encourage banks to lend more to try and keep the consumer side of it going forward. And it's, to me, that doesn't feel a very realistic strategy.
Well, we're going to get rid of this excess in the eastern states property market, and to relieve the 200% debt relative to anything really. That's just astronomical. We need a reset. We need a major deleveraging event, and let's just get the bloody thing over and done with. And look, all you're going to do is wipe out speculators. I mean, and that's all they are. It's like people that think they can go get into lithium or whatever fad, or buy a chain of coffee shops or a Jim's mowing business. They're just trying to get rich, on a bandwagon, and that's all this speculation is. So I think speculators get burnt, but this has sucked in a lot of hardworking people that are about to see their life savings wiped out to live in a house 50 kilometres from Sydney. I mean, it's stupid.
Yeah, no, I agree. So as we sort of come towards the end of this conversation, Tony, what are then your thoughts for next year? And, if you were a first-time buyer or a property investor, what would you say to those people, in the face of what you're thinking about in terms of the early part of next year?
Yeah, I still think I'm a chance of winning the bet with Kook, but I don't know how far we'll fall. And I think the Sydney market over the last month has fallen about 2%. I mean, that's just unheard of. And at this rate of collapse, it's going to be quite nasty. So I think that don't wait to see. If you need to sell, you've got to sell now, because if Morgan Kelly suggests 70% downside of what's already happened, a 10% fall is still nothing. And all you have to do is find one gullible buyer. I still watch Channel 95 and see the auctions, and there's enough people of Asian persuasion to sell into. You only have to find one. So I'm not being racist. I'm just saying I'm being observational. And there's probably still a lot of people that don't read the news or think that people like us are crazy. So I just don't be afraid to sell. And even lowball bids, you take them. You don't say, well, I'm not getting enough money. I want what I paid for it. Well, no. And I think that's just going to accelerate the collapse. I think the likes of Switzer and Kukulis are going to get very defensive. I mean, I used to do Your Money, Your Call at Foxtel for years, and I kept telling Peter Switzer, Sydney's going to come off 30%. And now suddenly I get attacked because of my views, and I just think that we need to get over this. We're not different to Ireland, that's for sure, and our falls could be just as bad. So I just see bad times ahead, and if you feel as though you need to sell, just do it.
And what about first-time buyers who are looking at the falls and thinking, well, I've got a bit of money, I've saved up a deposit, prices are down a bit, all of the governments, WA increased their incentives for first-time buyers. They're obviously trying to attract people in. What would you say to first-time buyers?
If you're in if you're in Adelaide or Perth, our opportunities for decent houses, it's actually quite cheap. You can buy a decent apartment with a 2 in front of it, 10 k's from the city. If you're in Sydney or Melbourne, you have to hold off. You just have to continue renting because you never buy the first dip or think that I could go in because the bank's lending is still very tight, as I've just experienced. I've been through it. So I wouldn't certainly buy the first dip when there's another 30% plus downside to come. I just think it's financial suicide. And the whole sentiment of Australian property ownership, it's changing. And I think we might go to a more rental system for a while until a mainstream economist says that property prices will never recover, and that'll probably be on the front page of the Daily Telegraph. So that's the buy signal. So
watch for that. Yeah, later in 2019, possibly.
Yeah. But I hate to bear bad. Look, I'm just being a realist. I mean, I've studied bubbles like you have. I've dealt with 1,000 people in speculative bubbles. I know the psychology. I've studied what Morgan Kelly said. Are Australian economists blind? And if you need any enthusiasm to sell, just watch The Big Short again, and that's my suggestion, Martin.
Yeah, I'm afraid The Big Short is very resonant of what we're seeing, and I actually watched that the other week just because I wanted to remind myself of some of the quotes in there, and I have to say more and more of the quotes resonate more and more with what we're seeing here. So
well,
it's really interesting.
It's like those brokers in Florida when he said, well, who's Warren Buffett? And he said, well, I'm a mortgage broker, now I own a boat. And the look on that guy's face when he took the piss out of him was priceless. And I think that's the whole emphasis of that movie. It's just a few quotes. And, but anyway, I think we're on the right side of this one, Martin. And if I lose that bet, it won't be by much.
No, okay. So your message then is to the DFA viewers is be careful. It looks as though there are more falls ahead. Be cautious and don't believe what you read in the mainstream media.
Absolutely.
Tony, I really appreciate your time tonight, and thank you very much for that. Seasonal greetings to you and to all the DFA viewers as well. And I'm sure we'll catch up again in 2019. Yeah,
well, in my new property, which would be great. I've got 4 weeks to pack. I'd like to tell people where it is, but no, there's too many crazies out there.
Yeah, no, fair enough. Well, I look forward to a different background next time. So
you will.
Great. Good to talk to you. Thanks, Tony. See you later.